This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So let's go through and have a look at capital maintenance. It could get quite complicated, but I just don't think that at this level it's worthwhile making it complicated. There's lots of detail within the study text of your chosen tuition providers, which, although it's relevant for the exam, I just think goes into the right level for the exam, but for you to spend time understanding it and digesting it, I think if you're looking to pass, there's more important areas to focus upon, okay? But don't neglect it. But you could go through and neglect it and it not appear. You could spend all your time on it and it not appear, okay? If it does appear, it's likely to be a multiple choice question for, 2 marks, is it there in section A, or a couple of marks there in terms of the published company accounts question, okay, or maybe bringing it into your groups scenario. So what's it all about? What are we talking about in terms of capital maintenance? Well, effectively, capital is the equity, isn't it? And what you should have is that if your closing capital is greater than your opening capital, then the difference between them is profit, isn't it? Okay. So if your closing net assets are greater than the opening net assets, you've made profit. So let's just go through it and draw that up. So you've got your opening capital. Let's just say that that is 100. Let's just say there that your closing capital is there as 110. Well, if that's the case, the profit that you're making is 10, isn't it? Okay, it's like a balancing figure. If you go back to where we were before talking through the framework earlier on in this chapter, we spoke about the fact that the focus is on the position, isn't it? If you get the position right in terms of the fair value, the movement, the difference, just goes to profit or loss or other comprehensive income, doesn't it? So here we're saying, look, we've got the opening balance sheets, we've got the closing balance sheet, the difference there is your profit. If the opening and closing figures are the same, then your capital has been maintained, hasn't it? If they're different, then you've made a profit or you've made a loss. What we need to go through and look at there, however, is when we look at this profit figure, we need to look there, and obviously we're not maintaining capital, we're improving capital by making that profit. We need to go through there and think about whether or not that capital has been effectively improved from a money capital perspective. Okay, so can we actually go through there and increase the wealth of the shareholders? Have we made them richer by generating these profits? And also there, from a physical productive capacity too. So the most common, before I get into the physical productive capacity, the most common form of capital maintenance is this money capital maintenance. Going through there, using, is it there, your historical cost accounting, cost, depreciation, looking at the transactions and their value in the past. If we have closing capital that is greater than the opening capital based upon historic cost, then that increase in capital must be attributable there to profit, because we've gone through there and bought and sold goods at a higher value and therefore made profit, and we have therefore got more money capital within the business. Okay. the physical productive capacity is effectively going through there and just looking at it in an ever so slightly different perspective. Because here, what we're looking at there is you're looking at it more from a number of units perspective. So based upon your closing capital figure here of 110, can I actually produce, have I actually produced more units this year than what I have done in the previous year? Because just because closing capital has increased doesn't necessarily mean to say that I have actually got more units in inventory and have produced more units this year as opposed to last year. Because the whole issue around your capital maintenance comes down to inflation. So if we go through there and just draw up a simple illustration in terms of looking there at this physical productive capacity and go through there and say, well, right, this is our opening position. So our inventory is, say, there as 10. So using the numbers that we had from our previous example here, opening at 100, closing at 110. So if that's the case, opening inventory is 100. The other must therefore be, 90. Give me my opening capital as 100, isn't it? Okay. Let's just go through that and say that my closing is 20. On my inventory, and then my other has to therefore be at 90 to bring us back to the 110. Again, you've got your profit in the middle there, which is effectively your 10. But we're looking now and beginning to think about inflation, because the reason why your profit has come around is because of the change in the value of the inventory. Now, if that change in the value of the inventory is because of inflation, and what happens there is that you have ultimately the same number of units at each date, then what you've got there, therefore, there is no profit, is there? Yes, I know there is a profit figure, but that profit has come around, hasn't it, purely due to inflation. It hasn't gone through there and allowed you to produce more goods at the end of this year than what you were able to do last year. Okay, you know, if we had 10 units in inventory last year, 10 units this year, then the only thing that's happened is that there's been an inflationary price increase, hasn't there? So that profit effectively isn't capital. Okay, it's not an improvement in capital. The capital is being maintained. So the problem, the issue that you have is how do you then go through there and deal with inflation when you have to look at things from a money capital or a physical productive capacity. Again, this physical productive capacity is just an idea. Businesses don't use it. They use your money capital in terms of capital maintenance and using your historic cost. But if you're going to go through there and bring in how we start to look at inflation within the financial statements, then what you've got there, two solutions are your CPP, your current purchasing power. So what we go through and do there on your current purchasing power is that we adjust your non-monetary items at the general rate of inflation. Okay, so non-monetary items, things that aren't readily converted into cash. So things such as PPE and inventory. Okay, so your current purchasing power is going through there and adjusting for your inflation. Okay. The other way in what you can go through and look at it is to use your current cost accounting. So is it there, your CCA for short, and that is going through there and adjusting those assets for the value that it has to the business. So when we're talking there about your value, we're thinking there about your measurement bases that you have. So thinking more about your realizable value. Maybe there, is it your fair value? And then once you've made that adjustment to fair value to your realizable value, then what you've got effectively now is that you've then adjusted this closing capital figure to take account of any inflationary adjustments. And what you've then got to go through and do then is you then think that the profit is now, okay, a genuine profit figure. Okay, so what you've got there in terms of your capital maintenance, you've got your financial capital maintenance. So using your historic costs, thinking about your current purchasing power to make adjustments to the non-monetary items. And then you've got your physical capital maintenance, or looking at it from an operational perspective. And the way we can go through there and adjust for that is looking at your current cost accounting. So adjusting the value of the assets to the most up-to-date value in terms of recoverable value. Thinking as well about your net realizable value. Again, have a read through the study text of your chosen tuition provider. I think you might just get a little bit intimidated, a bit freaked out by all the information that's contained within there. There are some more detailed numerical examples as to what we've just covered and seen there. I really don't think, and I could be wrong, that you're going to see any huge detailed numerical calculations. If you see numerical calculations, I think they will be reasonably straightforward. If it wasn't, dead simple. Miss that question and do one of the easier ones.